at the end of the reporting period, in this case that's going to be at the end of April, a business will normally prepare a cash flow statement. This is a simple report for the stakeholders to show the cash that came into the business during the period and the cash that went out during the period, and how much cash is left at the end of the reporting period. To do the cash flow statement, we need to have the cash data from the journal. So here we have the cash receipts journal that shows all the cash that came into the business during the period. For example, we had sales, we had GST, we had a loan. They are the sources of the cash that came into the business during the period, and the total was 20,860. That's the total cash receipts. Here's the cash payments journal. It shows all the cash outflows during the period: drawings, rent, stock, GST payments. They're the cash outflows during this period of time. We also need to know how much cash we had at the start of the period, and that's usually found in the original balance sheet, the balance sheet at the start of the reporting period. In this case, bank is an asset, 19,820. And so at the end of the period, in this case April, we're going to prepare an unclassified cash flow statement. This is exactly the same report as a statement of receipts and payments. So two terms, same sort of report: unclassified cash flow statement or a statement of receipts and payments, exactly the same thing. The receipts by convention are listed first, so you just go up to the cash receipts journal, find the first receipt, which is sales. Remember, the cost of sales is a non-cash item in the cash receipts journal. That just records the cost price of the stock that was sold. The actual cash inflow was sales, 12,600. So we go down to the cash receipts, down to the unclassified cash flow statement, and write sales, and the amount there was 12,600. The next inflow there was GST, 1260. So I'm going to write GST collections 1260. Of course, that's 10% of the sales. And in this business, during the month, there was a loan of $7,000, NAB loan, $7,000. We add up those three totals and equals 2860. That's the summation of those three figures there, and of course it equals that figure there, which is the total of the cash receipts less the cash payments. It doesn't matter which order we do this in. Drawings 1600. So drawings 1600. We've got rent 2000 there. We've got stock 3000 there. And we've got the GST payments of $500. We add up the total there and it comes to 7100. That's the same figure as that one there, the total of the cash payments journal for the period. Then we've got to find the difference between the cash that came in and the cash that went out. That's $7,100, and we call that change in cash. So 2860 minus 7,100, that equals 13,760. That's the change in cash. We now write the balance at the start of the period. How much cash was there at the start? This figure here, 19,820. 19,820. We add those two figures together, that is those two there, to get the final figure of 33,580, and that figure is the balance at the end of the period. Balance at 34, the cash balance at the end. So this unclassified cash flow statement, which could be called a statement of receipts and payments, exactly the same thing, just shows the cash receipts coming into the business during the reporting period, the cash payments going out during the same reporting period. It shows the total receipts, the total payments, the difference between those two subtotals, which is the change in the cash for the period. So 13,760 was an increase in cash flow during the period. We add that to the cash at the start of the period, which we found from the original balance sheet, to get this final figure here, which is the cash at the end of the period, $33,580.